The mutual fund industry has grown from strength to strength. Now, one of the watchdogs of the industry, which is an outsider but still trying to ensure investor protection, has been the Mutual Fund Advisory Committee, the MFAC, works closely with SEBI and with the industry. I have with me the chairperson of that industry, Mrs. Usha Thorat. In her earlier avatar, I have interviewed her as the Deputy Governor of the Reserve Bank of India. But it's a pleasure, ma'am, to interview you as the chairperson of the MFAC.
Thank you, Latha.
Okay, well, several issues actually, and it's, a hot investment vehicle, mutual funds. One of the things that investors and the industry worries about is benchmarks. If you look at the even active mutual funds and compare them to the benchmarks, many of them have underperformed. Is that something that the MFAC is thinking about? The industry's view is that the benchmarks are not appropriate. Have you all thought about it?
I think those who are saying this are looking at it very short term. And I think in short term is not the time horizon when one should be really looking at performance vis-a-vis benchmarks. And performance vis-a-vis benchmarks is also a question of the kind of risk attached to that performance. So it's always a risk versus return kind of a thing. Secondly, benchmarks are there so that the investor gets some kind of a transparency of how she or she should be assessing the performance of that particularly actively managed funds. And I'm quite aware that during the last 1 year, many of the really the glamorous or very popular mutual funds have not actually bettered, or in fact have been much lower perhaps than many of the standard benchmarks. This could be due to a variety of reasons. I would not, this is something, I suppose what we do here is that benchmarks are not that easy to replicate because of so many, there are so many issues and actually
there are exposure limits.
And then there are other costs which are also there. You don't look at those TER. And so when you compare the returns, you don't really compare oranges to oranges. But I don't think it's intended for comparing oranges to oranges. I think if you look at benchmark risk and benchmark return, an investor should look at it over a period. I don't think looking at it in 1 year, 2 year is a very fair thing to do, either to the benchmark, to the manager or to
themselves. Over a period of time, probably they would do better vis-a-vis the benchmarks. But another trend is the popularity of passives and ETFs. Now, of course, they are still not a large part of the AUM, but when they become popular, a large part of the money moves towards the Nifty. So there is a worry that maybe too much money is going only into Nifty stocks. Is that something also that you would worry about as an MFAC person?
Nifty isn't the only index fund or in passives. So there have to be other indices again developed according to the investor preference. So there are people who want to invest in mid cap, small cap, so they not necessarily go into Nifties. So I think here it's always a question of the investor preference. And I think passives are really the flavor of the future, especially when we are trying to make more penetration into household savings. I think the passive funds and the ETFs are really perhaps the way to push it forward. I know the kind of expense ratio in these funds is very, very low. SEBI has said, not more than 1%, but many of the funds are not even charging that. I understand that some are charging even just 0.1%. Where technology is obviously helping, reduce the cost. And the main trick here actually is to, and there's no question of beating benchmarks. So you have to get the benchmark itself. So I think many more benchmarks which meet the investor's preference. This is for me really the way that we should be going. In fact, I believe that globally, it's the passives and the ETFs which got a larger share of the
total, they've overtaken in the US.
Assets under management than the active fund.
Well, let me come to the point that you raised in your speech, that even today, institutions or corporates are a large investor in mutual funds. They are less than 50%, yes, but it is still a large amount of money. Do you think SEBI should actively try to, disincentivize the industry from
that? I think what happens is corporate and large investors, as of course pointed out by the CEO of HDFC AMC, globally, it is the case apparently that institutional investors are part of mutual funds. But I thought in India, the whole objective was to really go out to people who otherwise don't have the expertise to invest in these markets. And in a way, when we're trying to do investor protection, many of our concerns come from the retail investor and not necessarily protecting a more informed investor. So it's only a question I've raised as to, is there any way, firstly, is there any need? And secondly, how would you then incentivize the asset management companies into really targeting more of retail investment rather than institutional investment?
No, they're talking of two different institutions. I take your point, or I take Navneet Vinod's point, that EPFOs and even now government PSEs have been asked to invest or allowed to invest through mutual funds. But this specific reference is to private sector corporate treasuries. They are very savvy, and therefore if the mutual fund just gets that as AUM, that might be
there too I suppose I would really like to get more data to see actually whether that is, to what extent that is being used as an investment vehicle. I think corporate treasuries are perhaps switching more to direct, but I agree with you.
They use more liquid and money market.
Yeah, but I do feel that it is something that should be discouraged.
Okay. The question comes when you are trying to provide public protection in the form of, for instance, in
backstop
2020,
facility,
the backstop facility. Should you give public backstop facilities when the money involved is that of,
that is the question.
Private sector.
I won't talk about rich or poor. The point is they are all well-informed institutional investor and they get the advantage. Also, they are the first to exit.
Yes.
Fortunately, the swing pricing formula has sort of corrected that distortion. But the fact remains that, the really well-informed investors, whether they should be really coming into a system where protection is being given to what would be normally justified for the retail investors.
Okay. Mrs. Thorat, some more questions that you raised in your speech at the Moneycontrol event. You said that the role of the trustee, the sponsor and the AMC is not often clear. Can you elaborate? What exactly is your worry?
One is that especially in the very large mutual funds, where the sponsor is part of a much larger financial conglomerate, I would worry about the possible conflicts of interest. I'm sure these get addressed by ensuring arm's length and by having a oversight of this. So that was just one thought. The other thought is that do we really continue to need that sponsor? AMCs have come of age, they are independently listed, and they and the trustees have an agreement. So essentially the trustees' function is a oversight function, and they have to look at where the investors' interest could be compromised. I would say there's much more scope for going beyond the kind of tick box kind of compliance role to the trustees than making them ask the right kind of questions and look at possible sources of conflict of interest. I would say on the other hand, the AMC's role is a lot of it is operational, and the whole-time member of SEBI, Mr. Barua, very clearly articulated, there are risk issues at the scheme level and risk issues at the AMC level. So the AMC must be primarily responsible for those kind of risks and manage and mitigate them, as also ensure the mandate of the investor is adhered. My question I was raising is that it should not happen that we are overloading both these entities, especially the trustee, with responsibilities which are we want to really make the AMC squarely responsible for. So that is why I was raising this issue of whether there should not be more clarity in the role and responsibilities, and where there is an overlapping role and responsibility, where should the trustee be primarily responsible, and where should the AMC be primarily?
Do you worry that trustees are not independent enough?
I do worry that trustees, one, the independence, and secondly, the financial independence, because they are essentially dependent on the share of that TR only. Okay. So ultimately, I feel that we should reduce the cost of this structure to the investor ultimately who is paying for it. So that is where my concern is coming.
Okay, but therefore you would want them to be paid from some fund outside?
No, I'm not saying that, because we can try to look at it. I mean, I don't know what is the other. There could be maybe other, and ultimately it will all go back to the investors.
Yes, the investors have to pay for it.
So somewhere or the other it will come from that. I think the layers is something maybe we can minimize and make the cost of compliance with regulations much less.
All right, I know the SEBI itself is seized of the issue, and it perhaps need not fall in the fact terrain. You spoke about another important issue, that SEBI perhaps needs more teeth. That where they have been able to clearly indicate that the investor interest is compromised, still layers of appellate authority and high courts have
also the interpretation. No, I really feel very strongly about that. When you can take the case of insider trading. So when it is very obvious that based on information there has been some action which is on the basis of which SEBI has taken action, you can quote some other rules and regulations to challenge that very thing. Then we get completely caught up in the writing of the rule and not in the spirit. And it becomes so, subsequently so many litigations and counter litigations. So I feel that is where I feel strongly that, maybe because I'm coming from a banking regulation area where when it can be argued and established that this is in the interest of the depositors and this is in public interest, then that is what is really seen first. And the interpretation of the regulation is consistent with that objective of investor protection, detrimental to the interests of the investor. Those are the kind of concepts that we should be, holding to account when, taking a call on these judges.
This should be more appellate authorities and courts recognizing
I
SEBI's
think
expertise.
So. Yes, I'm not saying this one is wrong or that one is wrong. I'm just saying that is the spirit in which these interpretations should be done, because it's easy to hire the most expensive lawyers who will go on arguing your case.
That's a fair point. That's a fair point. Okay, is there any other conflict of interest that you worry about? This is something which even in your Reserve Bank avatar you may have thought of. After all, banks sponsor mutual funds, and both of them lend to companies. Companies invest a lot of their money in mutual fund debt funds. And their shares are purchased by the equity wings. So is there enough safeguards against conflict?
I'm not sure at all, because what you said is these are all sources of possible conflicts of interest. Insurance companies also subscribe to debt securities. Insurance companies are also part of the same group.
Yes.
And ultimately, when we talk about governance and when we talk about arm's length, it's, a lot can be, the very fact that we are sort of getting the kind of disclosures that needs to be got and the timeliness of these disclosures. And if they are not coming forward, the board, whether it's of the AMC or whether it is of the trustee, have to ask for those disclosures. So I think that would be quite an important.
Boils down to the trustees becoming more active.
Yes, and I think that is possible, because at least the right kind of disclosures one can ask for. You can always, you can say that it's not only the single exposure limit, for example. You want to know the kind of rating of those exposures. Have you taken a large exposure when the instrument is not that well rated? So there are various ways in which trustees have to, I guess, exercise their oversight role.
Okay. Well, finally, are you feeling confident about the industry? After all, it has grown a lot in the last 5 years. So you think the Indian investor is coming of age?
I think definitely the industry is, there have been no major mishaps. Several crisis situations have been kind of overcome. even though here and there may have been some transgression, this inter-scheme transfer of funds, for example. I mean, these are all things. So, but with a vigilant supervision machinery and the kind of credibility and reputation that the industry itself has to safeguard, I think there are built-in checks. But nevertheless, it is something that one can never be complacent about.
All right, thank you very much, Mrs. Thorat, for joining us in this discussion and putting the sunlight on several issues that beset the mutual fund industry. It's really riding a high crest, and one hopes it does very well.